2022 A-level paper MCQ question number 24 and 25 relevant for ratio analysis. They ask 24 interest coverage ratio and debt equity ratio, and 25 they ask return on equity ratio as well as inventory turnover ratio. It has given profit margin also, and 10% loan interest is given, loan obtained beginning of the year. That given from the beginning, equity is given, think equity and bank loan is given, sales, profit before tax, income tax, and average inventory also given. Right, interest coverage ratio can be calculated, profit before tax plus interest divided by interest, debt capital divided by equity capital debt ratio, and return on equity ratio, profit after tax divided by equity capital into 100, as well as inventory turnover ratio, cost of sales divided by average stock. Think cost of sales can be calculated by using profit margin. It has given selling price. Right, first one, interest coverage ratio. Think 2022 question number 24 and 25. Right, first one they ask 24. There's interest coverage ratio. Think interest coverage ratio can be calculated profit before tax plus interest, profit before tax plus interest divided by interest, interest expense. Now this is the way you have to calculate interest coverage ratio. And given profit before tax is given, think profit before tax equal 15,000, profit before tax equal 15,000, and bank loan it has given 150,000 into 10%. Loan obtained beginning of the year, therefore loan available during the country periods. 150,000 into 10% equal 15,000 annual interest also. Therefore divided by interest, there's interest coverage ratio. Here total money equal 30,000 divided by 15 equal 2 times. This is the interest coverage ratio. And second one there's debt equity ratio. Think debt equity ratio can be calculated debt capital divided by equity capital. Second part, think debt capital, as a debt capital should be considered non-current liability divided by equity capital. Divided by equity capital. Think debt capital equal in this example bank loan value equal 150,000, as a debt capital should be considered non-current liability, and as equity capital it is given equity 200,000. They think 150,000 divided by 200,000 debt equity ratio. Therefore 150,000 divided by 200,000, answer is 0.75. Debt equity ratio. Right. Therefore question number 24. There's interest coverage ratio and debt equity ratio. Answer is fourth one. Answer is fourth one. And question number 25. There's return on equity ratio. Question number 25. Return on equity ratio. Think return on equity ratio can be calculated profit for the year. It means profit after tax. Profit after tax divided by equity into 100 as a percentage. Profit after tax means profit for the year divided by equity into 100. It has given profit for the year. Profit before tax is given minus income tax. Profit for the year can be calculated. Profit before tax 15,000 minus income tax equal 12,000, and equity is given 200,000 as a percentage. Those are profitability ratios. Therefore 12,000 divided by 200,000 into 100. Therefore here answer equals 6%. Return on equity ratio 6%. Profitability ratio therefore as a percentage. And next one, there's inventory turnover ratio. Think inventory turnover ratio can be calculated cost of sales divided by average stock. Think cost of sales divided by average stock. It has given average stock, but think cost of sales is not given, but given selling price as well as profit margin is given. Think selling price and profit margin is given. Cost plus profit equals selling price. Cost plus profit equals selling price. Profit margin means profit decided based on selling price. Therefore, profit equal to 20%. Cost per equal 80. If it is given margin, selling price 100. Profit equal 20. Cost per equal 80. In this example, given selling price, sales value equal to 1000. Therefore, cost of sales can be calculated. This is the cost value. Therefore, this value divided by 100 into 80. 21000 divided by 100 into 80. Therefore, here cost of sales is equal 160,000. Therefore, this is the cost of sales divided by average stock and given average stock also. Therefore, 160,000 divided by average stock is given 20,000. Therefore, inventory turnover ratio equal 8 times. Think turnover ratio 8 times. And return on equity ratio equals 6%. 6% debt equity ratio. Right. Therefore, question of 25 answer. There's return on equity ratio equals 6% and interest inventory turnover ratio equal 8 times. Therefore, answer is a third one. Think ratio analysis. Ratios mainly can be divided by 5 parts: profitability ratios, liquidity ratios, leverage ratio, and efficiency ratios, as well as investment ratios. In this example, there's interest coverage ratio, leverage ratio, debt equity ratio, leverage ratio, but return on equity ratio, profitability ratios, and inventory turnover ratio, efficiency ratios.